Cost segregation, I think, is becoming more mainstream, and there's much more information out there in education about that concept.
Heidi, welcome to the show today.
Hey, thank you so much. I'm so happy to be here. It's great to see you again.
Yeah, so we often talk about real estate as having unique and extraordinary tax advantages over things such as stocks, mutual funds, ETFs, Bitcoin, really gold. What are some of those unique tax advantages that real estate has?
Yeah, I mean, it's unbelievable. A lot of times when I have conversations with investors and they start to learn about the tax advantages, it's like, wait, that can't be right. It's too good to be true. And then they're thinking, well, it must be that I'm able to write off certain things based on what I put down on the property. So here's the thing. You can go into commercial real estate as an investment property, and we're allowed to take depreciation. And just kind of going way back, really starting at the ground level, depreciation is ultimately saying that a building and its components have a certain useful life. The IRS says they'll last a certain period of time. And so they'll allow you to actually take a write-off, which is depreciation, a write-off of those assets as they're essentially being used up.
I think the U.S. is one of the very few countries in the world that gives you tax incentives that are so extraordinary, called depreciation. How does it work in a practical matter? So I have a house, townhouse, rental property, whatever. How does depreciation work really?
Yeah. So how it works is, it's a great question, because sometimes we have people say, well, I don't really even know what is depreciation. So let's just use an example. We're going to go buy a rental property. We're going to use this Airbnb for $500,000. And that $500,000, we're going to put 20% down. So we're going to put $100,000 down on this house. We're going to leverage or go get a mortgage for the remaining $400,000. The amazing thing is that $500,000 is our investment. We purchased the house or agreed to purchase the house for that amount, even though we only came out of pocket for $100,000. The depreciation of that asset, we have to take an amount out for land, because land actually does not wear out. So we take a piece out for that. Let's just say that's $100,000. We have $400,000 that we can take depreciation on. So we depreciate that. And what depreciation is you have your income. So let's say you've got $200,000 of income this year. You have a certain amount of depreciation. We'll use a round number and call it $25,000 of depreciation to make it easy. The depreciation reduces your income. So if I have $200,000 of income and I'm paying 37% income tax, state and federal income taxes on that $200,000, my depreciation is going to reduce that. So with $25,000 of depreciation, I now have $175,000 of income instead of $200,000. So that's where I'm saving taxes. It's the difference, or that spread of what the percentage is that I pay in tax.
Gotcha. Now you have to let me know where I can buy a house for $500,000 and make $200,000. We'll save that for another show. But yeah. So depreciation basically reduces your taxable income, and so then there's thing that called bonus depreciation. It sounds like an extra, like a bonus. But what is bonus depreciation versus, I guess, just regular depreciation?
So bonus depreciation is something that we've had bonus depreciation for many, many, many years. And what it is incentive. It's ultimately an incentive to drive business owners of any type to essentially buy things. So if we buy things, we're driving the economy, right? We're buying goods, we're buying services, we're paying taxes. There's all this stuff happening in the economy. So when we have bonus depreciation, it's encouraging business owners to go out and actually, instead of sitting on their money in stocks and bonds or other things, we really want to encourage and incentivize people to go out and actually spend money. Would you please go buy something? It makes our economy better. And so bonus depreciation actually changed in 2017. And for the first time, said that it will now apply to any used property, which means anything, even if it's used for real estate in this discussion, that means any existing property. If you go out and buy it, if there's anything within that purchase that has a useful life that is shorter than 20 years, you can take the whole deduction immediately. You don't have to take it over 20 years. So that includes something that might be 5 years, 7 years, 15 years, 20 years. Bonus depreciation at 100% allows you to just write all of that off immediately. And so that's kind of how it works, is it shortens that time frame. Instead of this 10-year write-off, we have a 1-year write-off immediately. So we can kind of talk about how that pertains to real estate.
Got it. So is there any kind of a strategy that makes the most sense as far as timing goes with this, or because it's carried forward, does it really matter? Can you talk about that a bit?
Yeah, so there have been some changes. One of the biggest changes with bonus depreciation, which we just touched on, as of last year, you cannot claim bonus depreciation retroactively. So what that means is if you're going to claim bonus depreciation, you have to do it on the tax return for the year that you bought that property. So if you bought it in 2021, you need to do your analysis and claim the depreciation on the 2021 tax return in order to claim the bonus depreciation. So that's significant because otherwise you can't claim bonus. You can still accelerate some of the assets, but you don't get this big lump sum we see on the bonus side of it because of how those rules are changing. So that's one reason that it makes sense to look at a property as soon as you actually buy it, as soon as you close on that, and that's a new asset. The second reason is that when you own real estate, particularly if you're planning improvements, we see so many investors buy property with a plan to then improve or renovate or upgrade those properties, especially in residential housing or multifamily. That's a really common scenario. So looking at the property immediately upon purchase is ideal so that you can outline all of those things that are essentially acquired on the date of purchase. And then as improvements are being made, you can add those new things. You can also take the old things out. So it's as if we want to identify everything on site as inventory and make sure that we're outlining that. So ideally, as soon as you buy a property, it's nice to kind of put that foundation in place. No pun intended, from the standpoint of having that inventory breakdown of everything that you acquired.
Yeah, depreciation is a magical thing. So when an investor invests in one of our deals or another syndication, for example, and they invest, let's say, $100,000, and we send them $10,000 in distributions, you know, they have income, and then all of a sudden they have a $50,000 taxable loss on their K1. And because of this bonus depreciation, because we can write off so much in that first year, and then that carries forward. So now they have a $50,000 taxable loss. Next year they make another $10,000, and it eats into that. Now they only have a $40,000 loss, and they're not paying any capital gains on this thing. It's magical, right? But what do you have to do, or what do we have to do, the operator? What do we have to do so that we collectively can take advantage of this form of accelerated depreciation?
Yeah, I mean, the foundational part of outlining all those assets and accelerating depreciation is utilizing the cost segregation study. So cost segregation, I think, is becoming more mainstream, and there's much more information out there in education about that concept. But cost segregation is really applying an analysis to a building so that instead of just simply looking at the building as an asset, we're looking at 10,000 different assets. You just paid $500,000 for this house. You can choose to take your standard deduction, which we described. That would be our $400,000 divided by 27 and a half years. Standard deduction, super easy. Your CPA can drop that on the tax return and call it good. But with the cost segregation, you're really choosing to say, hey, I want to itemize my deductions. It's exactly the same as when you file your personal tax return and say, do I want to go through the extra work to itemize? It's going to take me a little extra time, and I have to pull my receipts and make sure I've got all this documentation to support it. But if I itemize that, I'll probably have a larger write-off. And that's what the cost segregation study does. It creates the itemized breakdown of assets for that home, where we're seeing, look, we didn't just buy a house. We bought appliances and counters and countertops and carpeting and windows and roofing and some bushes outside and the sprinkler system and all these different things. And that is really where we're able to pull things out of sort of just that house designation and begin to take advantage of the bonus depreciation rules.